All right, time for another video. This one on econ. I want to start with housing. Recent chart I came across showed that the average cost to rent in this country is $2,100 a month versus $2,800 a month for owning. So the owning component would consist of things such as your mortgage, obviously, property taxes, which are way up because they're based on the most recent sale, right? And insurance, which has gone through the roof, which is part of the inflation problem, homeowners insurance. So you take that at 2,800 versus 2,100. Why the hell would anybody want to own? Because nobody really owns their house in essence, because the government always has a lien against it for property taxes, which is abysmal. If you want my take on that should be totally eliminated for everybody. And then you might say, well, where the hell is the municipalities and going to get the funding for civics, for services, public services? Well, how about a VAT tax? How about just going ahead and putting a little bit more sales tax on items at different levels, whether it be county, city, county, whatever, state. And that gets everybody. It gets the black market, the above the board market. It gets anybody that's buying anything. It's a consumption tax. That's fair. That's more fair. Anyways, I start out with that. Now, so on housing, why would anybody want to buy at the inflated values you have now post-pandemic, which are just now starting to come down when you're seeing massive spikes in inventory of for sale listings and sellers getting educated? This isn't advice for anybody, but if I were a seller of real estate, I would be selling now and coming down to fair market value to get rid of it, because by next year it's going to be really like trying to squeeze 10 pounds of crap into a 5-pound bag. Everybody's going to be rushing for the exits, and it's not going to work out too well. I'd like to move on also to the stock market. Well, actually, I'll go to the bonds first. Japan's 20-year bond is at 2.7%. I want you to think about that. And you'll say, well, what's that mean? What that means is 5 years ago it was at zero. Let me say it again, it was at zero. It's gone up to 2.7%. And you might say, well, what's the implications? The implications are one of the biggest, if not the biggest, bond buyer of our bonds, United States Treasuries, is Japan. So why would they want to buy treasuries here when they can buy their own treasuries there? And you might say, well, what's that mean? That means we can't fund, or we're going to have increasing funding problems for our government. And there's other reasons that we're going to have increasing funding problems, which is going to raise the interest rates. Because when there's more risk, purchasers of bonds and T-bills, etc., are going to require a higher rate of return to compensate for the increased risk. That is presently underway. It's called the bond market taking control. And that leads me to the Fed. The Fed can lower rates if they want. They'd be stupid to do it given the recent CPI, PPI, and the tariffs just now starting to work their way into the system and to the end purchaser. And heretofore, it's been documented that the sellers, the retailers, have been absorbing about 70-80% of the cost of the tariff. But they project that that'll go down to about 22% in the next year. That means that the rest of it is being borne by the end run purchaser. That'd be you and me, who are out buying product and services. So you need to think about that. That's going to spike inflation. So why the hell would the Fed want to lower rates here in September? I submit that they won't. But even if they do, it'll only be 25 basis points, because they just are going to throw the dog a bone to placate Trump, I guess. And then you've got this situation where Trump is firing Cook, her last name is Cook, from the Fed Board of Governors. Whether he can do it or not, I don't know. Based on the allegations that she committed mortgage fraud, I don't know. But he's just trying to stack that board to get a board of governors that wants to lower rates. I think the implications of it is Cook leaves, is Jerome Powell's just going to stay on for longer because he can. Okay, he doesn't have to be the chairman, but he can stay on that board. So, but he can stay as chairman obviously through next. I don't know. I can't remember when his term's up, but sometime late next year, I think. So you got that. Rates are going to go up. Okay. The stock market right now, the stock market's at the highest valuation it's ever been. Okay. That's pre-2029, or I'm sorry, 1929. And you know what happened right after that? That was the Great Depression. The stock market, crashed, and it led to the Great Depression. And then in 2000, the dot-com bubble. And in both cases, just like now, there's always this, oh, it's a new paradigm. Oh, it's different this time. Oh, it's AI. It's going to revolutionize everything. So, old valuation methods are out the door. In 1929, it had to do with industrialization. Everybody getting a car or having a chicken in the pot, whatever. In 2000, it was quote unquote the new economy, the dot-com economy. It's never different, okay? And the market is severely overvalued right now. In fact, like I said, it's the highest valuation ever. The Buffett indicator, the best investor ever, Warren Buffett, uses his own indicator, which is the percent of market cap to the gross domestic product. Gross domestic product is the net sum of all goods and services a country produces within its borders. So he compares the market capitalization to that. It's at the highest level absolutely ever. So there's another reason. And where's his money? I mean, his money's in T-bills, short-term notes with the government that are liquid, because they roll over quickly, and give a rate of return that is supposedly secure. Okay, so he's not in the market to any large extent like he has been. He's still in the market, but not like he was. So what's he see coming? Sounds like he sees a big correction in stocks and equities. And all this goes back really to 1971, which is when Richard Nixon took us off the gold standard because we were running into a problem then. And by taking us off the gold standard, it allowed all this bullshit to go on in monetary policy and fiscal policy, monetary being the Federal Reserve and all the crap that they can invent with quantitative easing and doing all types of things, and fiscal policy meaning the Congress spending money out of control like a drunken sailor on leave. So when you evaluate that and you think that we have a fiat currency, a currency backed by nothing. It's only backed by what people think. If people think it's secure, then it works. As soon as they start to suspect that it's not secure and not a store of value, then the whole thing goes kaplooey. There hasn't been in the history of the world a fiat currency that has ever survived. Okay, you need to think about that. So either we're going to implode, and whether we try to inflate away the debt, which I have explained in prior videos, or whether it just absolutely goes kaput, we're going to be going back to the gold standard of some sort. JFK, John F. Kennedy, he tried to do that and take power away from the Fed and issue silver certificates. So instead of that point in time when there was Federal Reserve notes, that's your dollar bills, $20 bills, whatever bills, money, currency, was backed by gold, he issued the orders or whatever that there'd be silver certificates so that those bills could be backed by silver too, because there's a lot more silver than gold. But that got quashed after he got assassinated. But again, it's an attempt to tether the currency to something of innate value, okay? And that hasn't gone on now for since 71, and you can see what has happened to our national debt. What's happened to our national debt? Well, let's see. In the first 191 years, so that would be basically from 1780, I got cut off. The national debt has grown since for over the last 191 years, from 1789 to 1981. $1 trillion. That's it. 1 trillion. All those years, 191 years. Now it's at 36 trillion and climbing $1 trillion every 5 months. The market is going parabolic. And that's what all markets do in the end. The debt is going parabolic. So you got to think of that. We've piled 35 trillion since 1981 and increasing now at the rate of $1 trillion every 5 months. That is not going to end well, okay? So anyways, combined with the other part of my video here, which I'm going to have to splice together because my camera got weird on me, camera phone, we've got some trouble, and people need to, take measures, whatever they think is appropriate for themselves to secure their existence. Some people will say, well, hey, you need to buy hard assets, housing, the inflationistas, it's all inflation. No, dude, when nobody can afford a house, house prices are going to come down, and that's exactly what's starting right now. And it'll continue to go down over the next couple of years. There's a lady on the YouTube who just is unbelievably good. Melody Wright, I think is her last name. I would encourage everybody to check out her videos because she's the only one that really knows what the hell she's talking about and analyzes everything in the mortgage service industry to residential real estate to commercial real estate, et cetera, and she's spot on. But things of innate value, gold, whatever, silver, yeah, those are hedges against inflation and what's coming. But I don't know if I have a clear answer, but I can say this, combined with the international situation, which I will not get into now on geopolitics, we're going to be going through quite a washing machine cycle of spinning and churning and everything else over the next few years. And it's going to be interesting for people, to say the least. But anyways, that's my video. Take care.